For years, Bitcoin critics repeated the same argument. It's too volatile, too speculative, too dangerous for serious capital. But something strange is happening beneath the surface of this market right now. The very institutions that once mocked Bitcoin are slowly beginning to position around it, quietly, carefully, almost reluctantly. And according to Cathie Wood, this isn't just another crypto cycle anymore. It may be the early stages of a global asset allocation shift that changes how wealth moves forever. Most people still think Bitcoin is competing with tech stocks. Cathie Wood believes it may be competing with gold, sovereign trust, and eventually the monetary system itself.
Base case is closer to 750,000, but the bull case involves a substitution for gold. So as generational wealth transfer takes place, we think that younger people are more prone to adopting a digital store of value. So that would be Bitcoin. The second is Bitcoin is an insurance policy, particularly in emerging markets, against fiscal and monetary neglect at best or corruption at worst. And so, as wealth increases around the world, we think that individuals will shift from stablecoins, and that's been a very interesting development, to Bitcoin, which has much more appreciation potential. But the biggest reason is institutional adoption. That is the biggest. This is a new asset class. It has very low correlation to other asset classes in terms of risks and returns. And so every asset allocator has a responsibility to examine it because it will increase risk-adjusted returns over time.
What makes this cycle different is not just price action, it's who is entering the market. Previous Bitcoin rallies were driven largely by retail speculation, leverage, and momentum chasing. But now the structure is changing. ETFs opened a gateway Wall Street spent years resisting. Pension funds, family offices, treasury allocators, and sovereign entities are no longer asking whether Bitcoin exists. They're asking how much exposure they can justify before everyone else arrives. And yet, most investors still psychologically expect Bitcoin to behave like the old cycles. Massive crash, long winter, retail capitulation. But markets evolve when new buyers enter, especially buyers with effectively infinite liquidity compared to retail participants. That's the contradiction nobody fully understands yet.
We're beginning to see the asset allocation shift. And yet we think that because of stable coins, that the dollar will also be strong. So effectively, stablecoin, so USDC Circle stablecoin and USDT Tether's stablecoin, they are backed primarily by U.S. treasuries. So to the extent they become successful around the world, we're going to be effectively exporting dollars, and that should be dollar positive. At the same time, we do think there is an asset allocation shift beginning towards Bitcoin and other crypto assets, again, because of the low correlation of return.
The deeper implication here is unsettling for traditional finance. Bitcoin was originally dismissed as internet speculation, but ETFs changed perception permanently. Once BlackRock entered the arena, Bitcoin stopped looking fringe to institutions. Suddenly, compliance departments could approve exposure, advisors could recommend allocations, retirement capital could flow. And now something even more important is happening. Scarcity is colliding with institutional demand. Bitcoin's supply is mathematically fixed, while global liquidity continues expanding. Governments continue issuing debt. Central banks continue protecting financial systems through monetary expansion. But Bitcoin doesn't respond to political pressure. It doesn't print more supply because demand increases. That changes investor psychology entirely. Gold historically benefited whenever confidence weakened in fiat systems. but Cathie Wood argues Bitcoin may now be absorbing part of that role, especially among younger generations inheriting trillions in wealth over the next 2 decades.
21 million units. We're up to 20 million that have been minted. Only 1 more million to go. So the scarcity value is there. And if you look at Bitcoin relative to even gold, gold supply increases at roughly 1% per year. And it might be more than that in the next few years because of what has happened to the price recently.
Right.
Bitcoin is mathematically metered. There will be no supply response. It's just mathematically metered. And right now it's increasing at 0.9% roughly per year. The supply is, which is lower than gold's long term. And in the next 2 years, we'll be down to 0.45% increase per year.
What makes this more psychologically powerful is that Bitcoin's volatility may actually be disguising a structural transition happening underneath. Most people still see chaos. Institutions increasingly see asymmetric opportunity. And historically, markets reprice violently once consensus shifts.
Since 2019, when institutions started considering this new asset class, you'll find a very low correlation between gold and Bitcoin, digital gold. Very low correlation. It's 0.14. So almost no correlation. But if you zoom back and you look at a chart, what you will find is in the last two cycles, gold has actually led Bitcoin. So it is very interesting in recent weeks how they've exchanged places. Bitcoin has developed a little bit of momentum. It's certainly in a bottoming out process, and gold has given way. And I think one reason that might continue, gold and the dollar are inversely related. We believe the dollar is going to go up because the return on invested capital here in the United States is rising relative to that in the rest of the world, thanks to deregulation, tax cuts, and so forth. So the dollar going up, we believe, is going to be a negative, a slight negative for gold here.
If Cathie Wood is even partially right, then Bitcoin's implications stretch far beyond price targets. This becomes a challenge to how capital stores value globally. Because once institutions begin treating Bitcoin as a permanent strategic allocation instead of speculative exposure, the available supply becomes dangerously thin very quickly. Only 21 million Bitcoin will ever exist. But there are trillions upon trillions of dollars searching for protection against inflation, currency debasement, geopolitical instability, and sovereign debt expansion. That imbalance is what bulls believe eventually creates the violent repricing event. But contrarians still argue Bitcoin hasn't proven itself during a true systemic crisis. Gold still holds centuries of monetary trust. Regulation remains uncertain. Governments may eventually resist decentralized capital migration. Those concerns are real, but the market may already be signaling something else. Even after multiple global shocks, ETF volatility, and aggressive monetary tightening, Bitcoin continues recovering faster than previous cycles. Long-term holders remain unusually resilient. Institutional inflows continue appearing during weakness. That behavior does not resemble prior speculative manias. It resembles an asset slowly maturing into financial infrastructure.
I think the Genius Act and soon, hopefully, the Clarity Act will set the stage appropriately for this space to flourish and for institutions, especially Clarity. I mean, the administration wants it done by July 4th, our 250th birthday, but I don't know if we'll get there. I think once we do, because the odds have gone up recently that it will be passed, that we will see much more of an institutional swoosh into the space.
The most important part of Cathie Wood's thesis isn't actually the million-dollar prediction. It's what must happen structurally for that prediction to even become possible. A massive transfer of capital from traditional stores of value into digitally scarce monetary networks. That's why institutional adoption matters more than retail excitement. Retail creates volatility. Institutions create structural repricing. And this may explain why Bitcoin's corrections are beginning to look different from previous eras. Every cycle introduces larger and more permanent holders. ETFs removed friction, public companies are accumulating, sovereign conversations are accelerating quietly in the background. And meanwhile, supply growth keeps collapsing every 4 years.
We think that younger people are more prone to adopting a digital store of value. So that would be Bitcoin. The second is Bitcoin is an insurance policy, particularly in emerging markets, against fiscal and monetary neglect at best or corruption at worst. And so as wealth increases around the world, we think that individuals will shift from stablecoins, and that's been a very interesting development, to Bitcoin.
The frightening possibility for skeptics is this. What if Bitcoin never returns to the old cycle structure people are emotionally waiting for? What if the massive collapse everyone expects keeps getting absorbed by stronger hands each cycle? That possibility alone changes investor behavior completely, because markets often move hardest when the majority expects the opposite outcome. Maybe Cathie Wood is too aggressive. Maybe Bitcoin never reaches 7 figures. Maybe governments slow adoption. Maybe institutions move more cautiously than bulls expect. But what if the bigger mistake is assuming Bitcoin will behave exactly like the past, while the entire market structure around it is changing in real time? That's the uncomfortable question now hanging over this cycle. Because if scarcity, institutional adoption, ETFs, sovereign demand, and generational capital rotation continue colliding at the same time, then the real shock may not be how high Bitcoin eventually goes. The real shock may be how few people recognize the transition while it was happening. And by the time the world fully understands it, the repricing may already be over.